Financial freedom is available to those who learn about it and work for it. With this word, I, CA Jyoti Sapra Madan, will help you in more details about the financial terms with the help of an Excel. First of all, in this example, over here, we'll help you to find out the earning per share of the companies. The information is given is, have a look, number of equity share we have given 25,000. The second case we have given 12,500. Next we have given the rate of equity share. In first case is $100. In the second case we have taken a same, that is $100. The third equity we have given a 25 lakh, and in the second case we have given 12,50,000. We have taken a situation. In the first case we have taken a debt as nil, that is a debenture, and in the second case we have taken a 12,50,000. Right? Now we have given an information earning per share, that is called as EBIT, and that is we have taken 2,50,000 in both the cases. One more condition is there, that if I have taken the money from the debenture holder, we have to pay the interest, and that interest rate we have taken a 15%. The tax rate is also given to us, that is 30%. Now in both the situations we have to calculate the earning per share, that is EPS. Now with the help of Excel, how we are calculating it? Again, please have a look. We have given the EBIT. We take it as is equals to what information we have given. That's enter it. Okay. Now in the first case, as we have not taken any money from the debenture holder, that means we don't have to pay the interest. Therefore, we have taken an interest as 0. Right? Now in the second case, after EBIT, we have to pay the interest. And after deducting the interest, what the result is? EBT, that is earning before tax. Now what will be the earning before tax? This value minus this value, right? And then the enter we get it 2,50,000. We were doing the case number 1, right? After that we have to pay the tax. Yes, but obvious we have to pay the tax. This value earning before tax, what the tax rate we have taken? We have considered a 30%. Enter it. Then it will be 75,000. That means if we are getting an earning before tax of rupees 2,50,000, we have to pay a tax of 30%, that is 75,000. The remaining answer will be called as earning after tax, and that will be 2,50,000 minus 75,000. Your answer will be 1,75,000. This is the first case, right? Now we are coming to the second case. We can do the same scenario. Like this is my EBIT, enter it. Is we are paying the interest? Yes, in the second case, we have taken the money from the debenture holder, and that's why we have to pay the interest. How much interest is there? This value multiply by your interest rate, that is a 15%, enter it. Right? Now you just have to copy this value, whatever we have done, copy it, and then you have to paste it. Or you can drag the item also. I know you are expert in that. You can do in that way. Same, you have to pay the tax. Again, you can easily copy your values and just put it Control V, right? The remaining balance again you will get in the same way. This value, right? We have to pay the tax now. This value multiply by your tax rate, that is 30%, and you get it 18,750, right? Now what is your earning after tax is 1,75,000 in the first case, and in the second case it will be 43,750. Now this is the earning which is available to the equity shareholder. Now what we have to calculate? We have to calculate the earning per share, and that earning per share will be calculated with the formula. What will be the formula? Please have a look. The formula is earning after tax divided by number of equity shares. What the formula is? Earning after tax divided by number of equity shares. Now in this case, what is the earning per share? Please have a look. Again, 1,75,000 divided by your number of shares in the first case is 25,000. Divide by this, you will get the answer. Yes, they were showing the answer, but doesn't mean you have to not to do it. You have to do it by your own. Again, with this same formula, what the formula is? Earning after tax, yes, very good, divided by your number of equity shares, that is 12,500, and you will get the answer of 3.50. Right. Now in this scenario, what you are analyzing, ma'am, it's better we don't take the money from the debenture holder, as we are not having to pay the interest. Very true. But once you are not paying the interest, your earning per share is 7 rupees. But once you are paying the interest, the earning per share is decreasing. is the condition, ma'am. That means we should take the money from the debenture holder and pay the interest. That means with that case, my earning per share will decreasing. But don't judge on the basis of this point. We have multiple examples and will show you the situation how taking the money from the debenture holder will be beneficial while calculating the earning per share. Right? This is the first point which we have discussed today. Now we are coming to the next point, next financial terms. That term is called as indifference curve. What the word is? Indifference curve. That means where is the point? Tell me the exact point where the earning per share remains the same. Whether the situation is 1 case, 2 case, 3 case and so on. Right? I am taking a 2 example of indifference curve. The first example is this one, in which I have taken the money from equity shareholder and I have taken the money from the debenture holder. Right? Please have a look on the question. The case number 1, number of equity shares I have taken 50,000 and in the second case I have taken 40,000. Rate of equity share is rupees 100 and that is $100 and in the second case is the same. The third equity that we have taken a 50 lakh rupees and in the second case we have taken 40 lakh. Right? And in the debt we have taken 10 lakh and 20 lakh. We have given the EBIT, that is earning before interest and tax, is 6 lakh rupees and 6 lakhs in both the case. And interest rate, but obvious, we have taken the money from the debenture holder, we have to pay the interest. And that interest is 12%. I have taken or assumed that the same amount of, same percentage of interest. Right? And the tax rate again I have taken a 30%. You can change the data and see the formula will change if you have put it everything in a proper formula. Right? Now I have to calculate the first situation, that is the EPS, which we have just discussed. But one more point added in this numerical, that is calculate the indifference point. Right? Now again we calculate the same scenario. Start doing it. Hope you able to understand the previous session. Now you can start it. Is equals to, that's your EBIT, very good. Enter it. You have to pay the interest in this situation. Yes, because we have taken the money from the debenture holder, we have to pay the interest. Right? Is equals to this debenture multiply by their interest rate, that is 12%. Enter it. Right? What will be the EBIT? That is equals to EBIT minus your interest amount, that the remaining will be earning before tax. We have to pay the tax on that. Is equals to your tax rate. We have given a tax rate of 30%. Right? This is the quality of Excel. Once you put the formula in Excel and then you have to do it very easily. Earning after tax, again the same point, EBIT, that is earning before tax minus your tax value, and your answer will be 3,36,000 in the first scenario. Right? Hope it is clear? Right. And then earning per share, again we have calculated in the same way. How we have calculated earning per share? Same. Earning after tax, whatever we have earned divided by number of shares. Right? Now what you have to do in a shortcut, what you can do it, just copy this value, Control C, put it over there and Control V. See, the data will come up. This is the way we can use the Excel in a proper way and get your answer in a very easy way. Right? Now please have a look on this example once again. We have taken a debenture of 10 lakh rupees in one situation and 20 lakh rupees in second situation. That means we have taken a higher amount of debenture. Right? But the scenario is the earning per share in the first case is $6.72 and in the second scenario is 6.30. Again, don't try to judge, means higher the debenture, lower the EPS, not at all. Again, we have a multiple example, will show you. Sometimes taking the money from the debenture holder will be beneficial to the equity shareholder. And that's why a one concept name as trading on equity, which we have discussed many times in the financial management. Right. Coming up further, now in this situation we calculate the EPS. But the new point which we want to know in this point is calculating the indifference point. How the indifference point will be there? That means, man, can you please tell me that before 6 lakh, if I want to enter that figure in which the EPS remains the same in both the cases, can I find that figure in which the EPS remains the same? Yes, we can find out with the help of indifference curve. How we calculate this indifference? Please have a look on the formula I have shown you over here. What is this? N2. That is number of shares in the second case multiply by L1, that is I. We have taken an I1, that is interest. That means in number of shares of the second case multiply by the interest of first case minus vice versa. Number of shares of the first case multiply by the interest of the second case, and whole upon divided by number of shares of 2 minus number of shares of the first case. Hope you have had a look on this formula. Now putting this formula, okay, I am putting over here for your helping purpose. See, is equals to, your bracket open, number of shares in case number 2 multiply by your interest element of first one minus number of shares of case number 1 multiply by interest of your second case, right? Have a look. N2 multiply by interest, N1 multiply by interest. Bracket close, then we have to divide by both the number of shares. Then we divide by bracket open. Always remember, when we have to subtract something, put it in a bracket. That will give you a more accurate answer. This value minus this value. Then we have to close the figure and just see the formula, and we put it in enter, and we get the value of 7,20,000. That means at 7,20,000, my earning per share will remain constant in both the case. Can we check the result of this? Yes, we can check it. Please come over here and have a look. Now in front of, instead of 6 lakh, I am putting 7,20,000. See the happening. 7, 2, 0, 0, 0, 0. It's 7,20,000. I just enter it. Right? In the same way, I am changing this figure of 7,20,000. And now, please have a look on the result. What the result is? The result is 8.40, 8.40. In both the cases, the EPS remains same. Yes, this is the point which I am telling you, explaining you, that indifference point is the point where that is the EPS in both the cases remains the same. So that means in this scenario, if I am earning that my EBT is 7,20,000, there will be no difference. I am taking a debenture of 10 lakh rupees or 20 lakh. It will show you no difference. Why so? We have just checked that EPS will remain same when we have 7,20,000 as EBIT, that is earning before interest and tax. Hope the second point is clear. In the first point, we have done the earning per share, and in the second point, we have calculated the earning per share and the indifference point, right? Now, in the case of indifference only, I've added one more example for you and making it little difficult for you. Let's see we can able to do it or not, right? In this example, the third example now we are doing, and in this example, what I have added, just a little more difficult for you. We have added a number of shares, that's 50,000, 40,000, the same. I have taken a number or rate of equity shares, that's again a same of 100 rupees. But in this case, I have added equity, right? And the second point, I also added the preference share capital. In the previous point, I haven't taken the preference share capital. Now I have taken a preference share capital of 20 lakh and 15 lakh also. I have taken the debenture also. That means in this case, I have taken the interest also, and I have taken the debenture also, and the preference dividend, right? Now again, the same scenario, interest rate is given, earning before interest and tax is given 8 lakh, 8 lakh, and the preference, you have taken the money from the preference shareholder. That means you have to pay them the preference dividend. And how much preference dividend I have taken? 13% in both the cases, right? And the third point and the last point, that is the tax rate is given to you. Now the question is the same. We have to calculate the EPS and we have to calculate the indifference point. Okay, in the first case, I think so you can easily do it, as we already done it, calculating the EPS. I'm just deleting this so that we can do it by your own. Deleting this, and we will check, are we getting the same result, right? Add in this EBIT. What is given EBIT? 8 lakh rupees. Enter it. We have given the interest. Yes, how we calculate the interest? How much debenture we have taken? Yes, this value. Multiply by interest rate, that is 12%, right? Put it, enter. Then again, what we have to add it? We have to get the EBT. that is earning before interest and tax minus interest rate. Enter it. Now you have to give the tax, but obvious you have to pay the tax, and the tax value will be how much? It's a 30%, right? Now enter it. That is earning before interest and tax, and you have paid the tax to the government. That is the most important. Okay. Now we have to calculate the earning after tax. That is 6,80,000 minus your tax value. Again, enter the value. Now in this case, as compared to previous case, we haven't paid the preference dividend in the previous point, right? Now we have taken the money from the preference shareholder. That means we have to pay the preference dividend also, right? Now give the preference dividend is equals to how much preference share capital is there? This one, multiply by your preference dividend of 13%. Now enter it. What's the value? That is earning after tax and preference dividend, this value minus your preference dividend, and you will get the answer of 2,16,000 is your earnings available to equity shareholder after giving the preference dividend to the preference shareholder, right? Now what we have to calculate? Earning per share. Again, we already told you how we calculate the earning per share. Your 2,60,000 divided by your number of shares. That is the same, right? Now I have to calculate in the second scenario. Again, I just copy this value, Control C, and putting all this value in Control V, and you get the answer. And yes, we get the answer. And this answer is what we have searched up. That 4.32 is the first case, an earning per share. And in the second case, I got the earning per share of 3.88, right? Now again, we have to calculate the indifference point. But now in this case, we have taken the money from equity shareholder also, from debenture holder also, and from the preference shareholder also. Now there is a change in the formula. Please have a look on the formula. The formula is this. The formula is this. Yes, the formula will be changed up as we have taken the money from the preference shareholder also in this case. Then how the formula is? Again, the number of shares in the second case multiply the interest of the first case minus same scenario which was earlier in the previous example. But now we have to pay the tax. That means 1 minus tax. And in this case, we have the preference dividend also. Then one situation is of debenture holder. Now we are taking the second situation of the preference shareholder also. This is the change of the formula. And then down point, the same, but we have taken the 1 minus tax, right? Now we will find, are we able to get the formula, putting the same values? Please start putting the values in the formula. What the formula is? Again, start up, bracket, take this number, right? Multiply by your number of interest amount in the first figure. What will be the interest amount in your first figure is this one, right? Please try to put the formula in the same way as it is there. Now minus the number of shares in the second case, right? Multiply by your interest amount. This one is your interest amount. Close the bracket. Multiply by bracket again 1 minus your tax value. Hope you are able to look the formula also. I'm just dragging to show you the formula once again. 1 minus tax rate, and the tax rate is 30%, right? Now close the figure. Now next we have to take the value. This is one of the values of the interest element, right? Now we have taken the second line, that is of preference dividend. Again the same scenario. Take this value, right? For the preference I am taking. Now multiply by your preference dividend. How much preference dividend is there? When I look, we have given a 2,60,000, right? 2,60,000 is your preference holders. Now the next further, we have to subtract minus. Then first share value, that is this value, multiply by your second preference value, that is 1,95,000. Hope it is clear. And then close the figure, close the bracket. Now on the denominator part, that is divided by, again bracket open, we have to subtract the number of shares of both the cases, this case minus this case, right? We have taken the number of shares, then multiply, and again we have to subtract the tax element, 1 minus, and your tax rate is 30%, right? Bracket close and then enter. We get it 714. This value will come up 927,142.86. This value will be 927,142.86. I can show you figure once again. Please have a look on the figure. function F2 I am showing it. Have a look. What we have done, we have multiplied the number of this element, multiply by your preference dividend, interest element in the first case. In the second case, 1 minus tax, right? This is the first scenario. And in the second scenario, we have taken number of shares, multiply the preference dividend, 2,60,000, minus again number of shares in the second case, multiply by preference dividend, and all upon divided by the number of shares in both the cases, multiply by minus tax rate, right? And the value will come up 9,27,162. Now with this value, this shows that the EPS will come same in both the cases, right? We have now look on this. Instead of 8 lakh, what I am doing now over here, 927, this figure, 142.86, right? See, EPS has changed up. Same in this way, I am changing the value of this 8 lakh. 927,142.86. See the same, the case answer will be there. That is 6.10 and 6.10. This is the scenario which shows when I got the EBIT of 9,27,142, we will get the earning per share the same in both the cases. So this is the quality of indifference curve. Hope it is clear. In the first case, we have done EPS. In the second case, we have done the indifference curve without considering the preference dividend. In the third example, we have done the indifference curve with the help of preference dividend, right? Now coming up to the next point of financial, like what is the leverage? Leverage is basically how much company has taken the money from the financials for the purpose of financials and operating purpose from the market, right? That's why we have divided the leverage into two parts, operating leverage and the financial leverage. We can understand this properly with the help of an example. Please have a look on this example. We have taken two cases of the data of the two company, A Limited and B Limited. We have given the sale. How much sale is given? 75 lakh, and the 10 lakhs we have taken 1 crore. Then I have given a variable cost. We always remember whenever we have given a sales, we have given two more elements like variable cost will be there, which changes on the basis of the sale. And one more cost is there, that is a fixed cost which remains same whether your output or the sale turnover increases or remain constant, right? In this case, I have taken the variable cost of the 30 lakh rupees and $30 lakh. Now I have calculated the contribution. How we calculate the contribution? Sales value minus the variable cost, and we calculate the contribution. Hope you understand how we calculated this contribution. This value minus this value. Sales minus variable cost, that will get it contribution. From the contribution, we deduct the fixed cost. Whatever the fixed cost is there, we deducted it, and we get the EBT. That is earning before interest and tax, which we have done. After EBIT, we always pay the interest element, and in this case, we have taken an interest of 7,50,000. The result will be EBT, that is earning before tax. Having a look on this, are we getting the same? Yes. EBIT minus interest, that is EBT. Now the point is this, what we have to calculate? We have to calculate the financial and operating leverage. We have discussed the leverages of two types. Basically, we have given three leverages: operating leverage, financial leverage, and the combined leverage. Okay. Now having a look how we calculate this. The first one is the operating leverage. Operating leverage is required for the day-to-day activity. We have taken the money, but for that we have to make it clear that this expenses should not be more than what we are required. Otherwise, your company will be get more levered towards the organization, and the liability will be increasing. Okay. The formula for this will be contribution divided by EBITDA, that is earning before interest and tax. And in this case, we have given a contribution. Please have a look. That's this value, and your EBITDA is this value. Now you can easily calculate it. Is equals to your contribution divided by your EBITDA, that this value, and you will get the result of 2. Okay. Your operating leverage is 2. And in the same case, can we calculate the value for the second case? Yes. Control C and copy, and you will get the answer of 2.33. This is the operating leverage of this question. In the second, if we have to find the financial leverage also, Can we calculate the financial leverage? Answer is yes. And how we calculate the financial leverage? The formula for financial leverage is EBIT divided by EBT. Earning before interest and tax divided by earning before tax. Right? Again, just put the value is equals to EBIT is given. Yes, it's this value divided by what is EBT? This one. And you enter it and you get it 1.5. Same value you can copy it and put it for the case number 2 and you will get the answer of 1.5. That means with the help of this we are able to calculate the second term, that is operating and financial leverage. Right? This is about the leverage numerical question, very easy numerical question I have taken. Multiple examples of this, we can do it later on. Now can we proceed with the next very important point, that's a dividend policy. Yes, the financial management has to take a multiple decisions. Hope we all know this. Basically, financial management has to take the 3 important decisions. The first decision is always financing decision. From where we have to take the money and how much money we require to take up. This decision is taken by the finance manager under the category of financing decision. Right. The second decision, the financial manager has to take the investment decision. Where to invest the money? Are we investing the money in the proper way where it is required? Are we getting the proper return or not? The second category is your investment decision. And the third but not the least category and the very important decision is the dividend decision. How much to pay the dividend and how much to retain for their growth and development. Right. Third category is the dividend decision. With the help of dividend decision, we decide many further topics like how much dividend we have to pay so that we can focus more on the growth and development of the business. But now, here we have given a famous writer, that's a Walton model. Walton has given some decisions on the basis of internal rate of return, that is IRR, and cost of equity, that is KE. They have given us 3 cases. Now I am explaining the Walton's model with the help of that 3 cases, with the help of a numericals only. So that the practical approach will help you and you can easily analyze the situation in your mind. Having a look on this case which I have taken an IRR. What is this IRR? Is internal rate of return, that is R, and I have taken in this case is 15%, right? The second, that is KE, that is called as cost of equity, and I have taken in this case cost of equity of 10%. That means in this case, I have analyzed the situation where rate of return is greater than your cost of equity. Your R is greater than cost of equity, right? And one more thing we have given, that is earning per share we have given, and that I have taken $50. This I have given earning per share, that is E, and that is $20 I have taken up, right? Now what we have to use? Using the Walton model, calculate the effect of dividend payment on the value of the shares of ABC Limited. That means you have to calculate the market value of this share with the help of Walton's model. Now what the Walton model have decided I am explaining you with the help of this example. Please have a look. And again I have taken on different situations. They're like in the dividend payment ratio, I have taken a scenario of once I am paying a 0% dividend. In the second, I have taken a 20% dividend. Third is 40, 60, 80 and 100. Right? That means my dividend payout ratio is increasing day by day. Now we will check the effect of this dividend on the market price of the share. First, we should know the formula for the market price of the share. And the market price for the share is, please have a look, is yours dividend. Your market price of the share is dividend value plus bracket your R, that is internal rate of return, divided by KE, that is your cost of equity, bracket close. Then it's E. E is EPS, earning per share, minus D, that is your dividend, and whole upon your KE, that is cost of equity. This is your market price of the share with the help of this formula, and this formula is given by the Walton's model. So with this formula, we are able to calculate the value of market price of the share, right? Having a look on this formula once again. The formula will price of the share is equals to dividend plus that is your R, that is internal rate of return, divided by KE, that is a cost of equity, bracket close. Once we divide this, multiply by E, earning per share, minus dividend, right? And whole upon, that is cost of equity. Now we use this formula and see the scenario, will the dividend will affect the market price of this company? Come and we do up this question now. Hope it is visible now. Okay. So what we have given, dividend payout ratio, that we calculated as DPR, that is dividend payout ratio. I've taken a dividend payout ratio of first scenario, that is 0%. With the help of data validation, I've put in a scenario over here, that is I've taken a 0%, I've taken this 20%, 40%, 60%, whatever the situation we have taken, we have put in the data validation. If you know how to use it, okay, otherwise I'm telling you over here, like this, is equals to this 0%, enter it, right? Go to the data and use the data validation. Here it is a data validation, right? Select over here as a list, right? And in the source element, what we have to do, this value, select this value which I want to use it, right? And then enter it. This is the data validation, we put it over here. Okay? Chalo. Coming up to the next case, we have given a dividend paid. And now we have taken a different scenario, how much dividend we were paying it. Now using that dividend scenarios of dividend payout. Like in the first case, we have taken a 0% and how much dividend we are paying? 0%. Of what? That obvious, what we are earning it, right? Is equals to, I've taken this DPR, that is dividend payout ratio, multiply by your EPS, that is $20. And enter it, again it's dash. Why it is dash? As we have taken a 0% dividend, right? If I change this value to 20%, see the value will change up, right? This is the quality of your Excel. Now what we have to calculate the price per share. How we calculate this price per share? Again with that formula only we get 300. I'm showing you how we calculate this formula. Hope you remember the formula is this. Dividend, again applying this formula only in front of you, is equals to, that is your dividend. What dividend we have paid? This one, right? Plus, what is your R value? Your internal rate of return which we have taken, or it's given in the question is, this is 15% divided by your KE, that is cost of equity, that is 10%, bracket close, right? And then multiply by, again bracket open, your E minus D, that is your earning per share of $20, minus your D, that is dividend what you have paid, bracket close, divided by your cost of equity, and your cost of equity is, this case is 10%, right? Enter it and we get the value of 300. That means if I'm paying a dividend payout ratio of 0%, we get the market price of the share is 300, right? Now I'm helping you and finding out the values. Ma'am, if I've taken a dividend of 20%, what will be the scenario in that case? See, I've taken a 20%, the market price of the share is decreasing. That means if I'm paying the higher dividend, the market price is going decreasing. Coming on the third case, have a look. I've just changed it to 40%. Now the market price is 188. On the third next case also, 60% I've selected. Again 132. Hope you have a look on this figure that the market price is decreasing. Higher the dividend, lower the market price. Coming up to the next case, that is 80%, only $76. Next case, that is 100% and $20 per share. That means think it before paying the dividend. If you are increasing the dividend payout ratio, your market value is getting decreasing. But remember, you have to think the scenario of taking the internal rate of return of 15%, that is IRR, and your rate of return, that is a cost of equity, as compared to IRR is less than, right? What happened? I'm now changing the figure. Now I'm changing the figure so that you analyze it properly. What I have done, as all it is done in the figures, all the formulas are put in now. Right? One situation I have taken the R that is internal rate of return, is greater than 10%. That is greater than 10%, that is cost of equity. Now in the second situation, what I am doing? I am doing this as a 10%. Hope you have a look. I have done this as a 10%. Why I have done it, will show you. Now what happened? When my R, that is internal rate of return, is equal to cost of equity, that is K. Now, whatever the dividend percentage is, the market price remains the same. The market price remains the same. We'll check up. See, when I am paying 0 dividend, what my market price is $200. Now I am changed this figure to 20%. But my price is getting 164. Now if I am changing it to 40%, it's decreasing. Now I am changing it to 80%, again is decreasing. Now I am changing to 100%, again it's decreasing. But what happened is I have changed the figure of dividend payout ratio. Yes, it's 0, that means 200. Again, my rate, internal rate of return and the cost of equity is same. Then there must be, that your return should be same. Market price should come up same, right? But now I am taking a next scenario or taking it as an 8%. Then what will happen up? See, then what will happen? It's 0, that is 160. Well, once your return is less and your cost of equity that you are paying a return to the other person is 10% and you just earning 8% and still you are paying dividend. No, in this case we have taken only 0% dividend. Then your market price will be 160. But once I increase the dividend to 20%, your market price is 132. Changing the figure to 40% is decreasing. It's having a look, it's decreasing. So you have to take the scenario and the situation properly, understanding what is my rate of return. What I am exactly getting it. Is the same figure I am getting it? I am changing the figure so that you can understand it properly. I am doing in the same scenario, just 15% in the first situation, which I have taken. My rate of return is greater than cost of equity. Right? In that situation, Walters has always said it, pay the dividend properly, analyze it, and then only you find the market price of the share. If you pay more dividend, the market price decreases. And in the same case of ITC also. In this scenario, recently, the ITC has declared the dividend. Once it declares the dividend, the market price of the share decreases. So you have to decide in a proper way when you have to pay the dividend and how much you have to pay the dividend. This is one scenario of the Walters model. And how we have checked how the Walters model affect the dividend policy of the company, right? But not only one writer is there, that is a Walter. We have different models also, like we have the second model is a Gordon model, which we will discuss later on. In today's session, we have discussed the Walter model. Please revise all the topics properly, what we have done up. Just a short recap of all the data we have done up. We calculate the earning per share, right? We calculate the indifference curve, right? Indifference curve, we have calculated the two scenario, taking only preference dividend and one is taking the preference dividend interest both, right? And in the third case, we have done the dividend decisions, and in the dividend decisions, we have started up with your Walters model, and in the second session, we will go for the Gordon model. And one more topic we have discussed today, that is leverages, operating leverage and financial leverage. Okay, thank you so much for today's session. Bye bye.